Hey everyone, in the video today, I will be sharing the 50 dividend stocks that I own in my personal dividend stock portfolio. I will be going through all 50 one by one. As I go through each stock, I'll be sharing with you my favorite metrics about that particular stock. I'll be sharing some product samples and also my favorite thing about owning that stock and my least favorite thing about owning that stock. Also, I'm going to go through these stocks in descending order of priority so you can get a better feel how I stack rank the 50 stocks that I own in my portfolio. Before we get started today, I please encourage you to smash that like button if you enjoy the videos that I share here on YouTube. That means the world to me. And also, please don't forget to hit that subscribe button and the notification bell as well, because I have just reached 75,000 subscribers thanks to all of you in the community, and I have so much more amazing content on the way, so you don't want to miss out. Hey everyone, this is going to be a really exciting video, so let's get started. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So let's start with my number one favorite dividend stock of all time and the largest position in my dividend stock portfolio. This is Johnson & Johnson, ticker symbol JNJ. I really love this company because it's almost like owning a mutual fund within the healthcare space because it gives me access to consumer products like these Band-Aids. It gives me access to medical devices and also to pharmaceuticals. And so sometimes when I do these videos, I don't have that many props, too many props to share as it pertains to Johnson & Johnson. So this time, however, to celebrate my favorite dividend stock of all time, I really went around the house and I have a lot of props to share just to give you a better flavor of what this company is all about. So they also make, you may not know, the Lubriderm moisturizer. And so if you have dry hands, dry skin around this time of year, this is a great one. They also make the Johnson's baby shampoo, another wonderful product for kids. They make Neutrogena. You may not know about the Neutrogena sunscreen, but this is another one that I love so much. Keep the skin protected out there in the sun. They make Neosporin as well, which is really helpful when you cut your skin or your kids cut their skin by accident. And last but not least, we have the good old Tylenol as well. And so check it out on the screen right now. I want to share just a few quick metrics about Johnson & Johnson. It may seem like it's richly valued right now. It may seem like it's overvalued at $160.50. But when I look at a 2021 forward PE price earnings ratio, I get a 16.88, which I believe is a favorable PE ratio for this amazing company. And so I like where it's valued right now. The dividend yield is lower at 2.5%. But there's a lot of room to grow it because the payout ratio is only 42%. And as you can see, the market capitalization is $422.5 billion. So this is a very large company. It is very stable, steadily growing, if you will. Now, the largest issue with Johnson & Johnson, in my personal opinion, is could the government come in and start regulating healthcare more? Could the government come in and start talking to these companies, arguing with these companies, if you will, over their pricing model as it pertains to prescription drugs? It's a difficult situation because companies like Johnson & Johnson work so hard to develop these drugs and the patents only last 20 years. However, also from a consumer standpoint in the United States, these solutions are so expensive. And so that is a hot topic right now in the political climate in the United States. And it could potentially affect companies like Johnson & Johnson. So I'm sharing both the pros and cons today. In the interest of time, I'm going to keep moving. I want to talk now about my number two favorite stock, PepsiCo. This is ticker PEP. And I love this company because a lot of people think about Pepsi and they think about Pepsi-Cola, but you may not realize they also make a variety of snack foods and other beverages. And my favorite thing about PepsiCo is that they own Frito-Lay. So I want to share some of those props with all of you right now. So first and foremost, you may not know, but they make this bubbly sparkling water. I love bubbly sparkling water. It's a healthy alternative to soda. I don't really drink soda anymore. And so having a sparkling water and being able to enjoy it like this one, I found that the bubbly brand is really good. And so that is an awesome product from PepsiCo. You may not realize, but they also make a product called Izzy. The Izzy sparkling beverages, these are kind of like a sparkling fruit juice. They are really, really delicious in my humble opinion. And I don't have a lot of chips or snack foods around the house here because I have them all in my office, but I did happen to have this bag of rolled gold pretzels. And so this is an example of the types of snack foods that Frito-Lay produces. Now let's keep going. Check it out on the screen right now and I'll share you some cool metrics about PepsiCo. And so it's trading at $137.80 right now, and that places it at a forward price earnings ratio of 22.78. When I say forward, this is what the analysts are expecting that the company earns in 2021, and I take the current price and divide it by that, so it's a forward PE. The dividend yield is 3.0%. I highlight the metrics in here that are exciting to me, and so for me, I am excited to be able to enter Pepsi here at a PE ratio, honestly, of 22, which is a fair value, but even more exciting is the dividend yield of 3%. With a payout ratio of 67%, the payout ratio is a little higher, so I do think dividend growth will be a little bit slower in the coming years. I like that their market cap is big as well, 190 billion. This is a very large company. It's not going anywhere. They're the clear leader in salty snack foods, and that's through Frito-Lay, and that's why I love the company so much. Now, I would say one of the things I don't like quite as much about the company is the higher payout ratio. It does leave a little bit less room for dividend growth in the coming years. And so that's something where I expect lower dividend growth. All right, let's keep moving. My number 3 favorite stock of all time is none other than McDonald's. I love McDonald's because it's a real estate company and because it's a restaurant company. Not only is their food delicious and tasty, it's one of those things that maybe people don't brag about, maybe people don't talk about so much, but the statistics don't lie. Everyone likes to go there and eat and enjoy McDonald's once in a while. Especially for me, those delicious chicken McNuggets and French fries are unbeatable with the barbecue sauce. And so in terms of props today with McDonald's, I've got these trolls. And so this is the cloud guy, and here I've got Tiny Diamond. One of the things that's so exciting about McDonald's is that they offer these Happy Meals, and it's a great family experience, not only for the parents because the food is so tasty and reasonably affordable, but it's great for the kids as well because the kids get something really fun. And my kids, they really enjoyed collecting these Trolls collectibles because Trolls World Tour was such an amazing film, such an amazing movie that the kids liked. And so this was a great opportunity to go as a family and enjoy McDonald's. Now, obviously, McDonald's is not an everyday restaurant. It's more of a splurge, a kind of a splurge in terms of calories and kind of what you're consuming, so you don't want to do it every day, but everyone enjoys that guilty pleasure once in a while. And so with that, check it out on the screen right now. I want to share a few metrics about McDonald's. So this one is more expensive. I'm not purchasing it here. So J&J, PepsiCo, I could totally see myself purchasing those stocks at current levels. But with McDonald's, it's quite expensive at a PE ratio of 26.7. I would wait for it to come down a little bit to purchase more. The dividend yield is 2.3%, payout ratio 60%. And so honestly, I don't really see a compelling reason to buy now, but it is a company where if it ever does dip in price, I will add to my position. By the way, all of the stocks I'm mentioning today, I personally own in my dividend stock portfolio. And by the way, I have a Patreon. I will link to it in the pinned comment below. If you head on over to my Patreon, you will be able to unlock my bonus videos. I think I'm up to about 24 bonus videos there on Patreon, as well as some bonus analysis. And so I have 145 patrons over there that you can enjoy. And that you can gather together with. And what I would say as well on Patreon is the document in the video today that I'm going through will be available there as well. And so as it pertains to McDonald's, one of the things I really love about the company is they did a lot of refranchising, meaning they found that their franchisees are able to operate their restaurants better than the company themselves. And so basically they have franchisees running the restaurants. A lot of them now, they stopped running it as a corporate operation, but they basically retained the rights, the ownership to the land. So they're the landlord, if you will. And so this is a real estate business, not necessarily only a restaurant business. And that's one of the things that I love is they own so much quality real estate. They don't let go of the real estate. They own it. And they rent the real estate to those who are operating a lot of these restaurants. And this throws a lot of people off because when you look at the revenue at McDonald's over the years, it has gone down certain years, but that's honestly just because of the refranchising, because a lot of the revenue that would have showed up at the top line on McDonald's now shows up at their franchisees, but they're collecting that solid cash flow on the land. And the margins have expanded and the earnings are strong. Now, the only thing I don't like about McDonald's is the valuation. So let's keep going. That's number 3. Number 4 I want to share with you is Clorox. Actually, before I show you the metrics on the screen, we all know in the middle of the pandemic how important these are. There is nothing really more important these days than keeping surfaces clean, keeping doorknobs clean, wiping down surfaces with Clorox wipes. And so this is a golden product, but it's not the only product. They have so many wonderful products at Clorox, like the Clorox bleach, Burt's Bees, and more. With that, check it out on the screen right now. And so you'll notice a theme as I go through the video today. I'm going through a variety of industries. I started with healthcare, then consumer packaged goods, food, then basically restaurants and real estate. Now I'm into consumer packaged goods. And I love right now, I recently bought some Clorox. I love that the PE is down at a 22 on a forward basis. This isn't that strong of a PE or too much of a value of a PE, but for Clorox, it never gets cheap. And so I did buy some more. Dividend yield is 2.3%. Not great, but the payout ratio is only 53%. So there's room to increase the dividend. I love that the market cap is smaller too. I highlight that. That leaves it more room to grow. Now, I love this company because they produce the products that we all need to live. The thing I don't like about the company as much is that they are mainly US focused. They need to continue to expand internationally. I'd like to see more of an international presence because I am a global investor, but I do own some stocks in my portfolio that are largely focused on the US, and I would prefer to have more of a global exposure. And so that's number 4. Let's keep going. Again, I'm going in descending order of priority. So I'm going from my favorite to my least favorite. Of course, I own all 50, so they're all my favorites, but I do rank them within the 50. And so with that, I've gone through number 4. Let's go to number 5. I want to talk about Duke Energy. I don't have any props for this one today, but check out the metrics on the screen. Like McDonald's, this is another one that's focused only on the US. This is a utility company with a price per share of $93. PE is about 17.94. I highlight the dividend yield. It's 4.1%. For dividend investors who need cash flow now, they want to live on cash flow now, they want to retire now. I love regulated utilities because they can provide that stable, dependable cash flow from the get-go. Payout ratio is 74%, which is actually not too bad for a utility. Market cap $71 billion. What I love again, is that regulated electric utilities provide stable and growing cash flow. The prices are set in conjunction with working with the government. Competitors cannot come in because these are regulated in the markets that they're in. And that's exciting. Now, one of the things that I would say about something like Duke is capital expenditures are very high. They have to invest in their power production capacity. They have to keep investing in the company to keep it going. And that can get very expensive. And so these types of companies can have a lot of debt. And they rely on the government to push through pricing increases. They can't just increase the price. They have to work with the government to push through pricing increases. But they do have a monopoly, if you will, on the markets that they're in. And so there's pros and cons. But I include a utility so high up in my list because I am someone that's using cash flow right now to pay a lot of my bills. And so with that, I want to move on to a real estate investment trust. I don't have any props for this one either, unfortunately, but it is an amazing company. Check it out on the screen right now. And so this is number 6. It's Realty Income. This is a real estate investment trust. This is a triple net lease company. And so what they do basically is they own all kinds of properties around the world, mainly a US focus, but all around the world. I'd like to see them get more internationally. And what they do is they collect rent on those properties, but they don't have to deal with tenant improvements. They don't have to deal with property taxes. They don't have to deal with a lot of the overhead of actually managing those properties. All of that is delegated down to their tenants. They just collect the rent. And so it's a unique and innovative business model. And you can't really look at a PE ratio on this one. Since it's a REIT, you have to look at adjusted funds from operations. It's at an 18. So I think it's probably pretty fairly valued in this market, given that they do own a lot of fitness facilities and movie theaters, which are under pressure because of the pandemic. The dividend yield is 4.5%. Payout ratio 74% on AFFO, which is around where I would expect it to be. I think that implies, honestly, that they could probably, over time, continue to increase the distribution. Market cap is $23 billion. And so they are a pioneer in triple net leases. That's something that I really love about this company, and I think it's a very innovative business model because with triple net leases, they don't need a lot of overhead at the corporate office. You would actually be surprised for a $23 billion company. They don't have that many employees. So it's a business model that offers scale. I always love investing in scale. Now, in terms of issues, the pandemic has really affected companies like this. This is the type of company that owns real estate, all kinds of real estate. And some of the real estate they own, for example, is rented out to companies like Walgreens. That's going to do just fine. But real estate they own that is rented out to fitness facilities, I really am rooting for the fitness facilities, but it's going to take some time to fully recover from this pandemic. So that's Realty Income. I want to get into my next favorite dividend stock of all time. This is a big one. This is one where I do have some props, but what I'm going to do is I'm going to go through the metrics first, and then I'll go through the props. So check it out on the screen right now. I want to talk about Procter and Gamble Company, ticker symbol PG. And this is my favorite dividend stock, number 7. So Procter & Gamble is trading at $130.18, which puts it at a 2021 forward PE of 22.92. Honestly, not so bad. Honestly, these days when I look at PEs in this kind of range, I feel all right about them because at this particular time, the government is implementing an unprecedented amount of stimulus and money printing and fiscal policy. And so when I look at something like that, I look at my tried and true dividend stocks as a hedge against printing of money, as a hedge against inflation. And that is something that I love about these companies. And I think going forward, they will continue to probably trade at higher multiples just because of what's happening with the US dollar and currencies all around the world right now. So that's a piece of context I wanted to provide. Dividend yield is 2.4%, a little bit lower, but honestly, these are all dividend growth companies. Most of the ones I'm mentioning today increase the dividends over time. And one of the key lessons is it doesn't really matter only about the dividend starting yield. If you have some time on your hands like I do before I fully go financial independence, retire early, I'm setting kind of a hard stop for me 10 years from now where that's going to happen one way or another. I have some time, and so I can buy stocks that have a lower yield to start, but increase the dividend year over year over year, like Procter & Gamble. I love the lower payout ratio, and I love that it's a big, stable company with a large market cap. Now, what do I love the most? I love the fact that they have all the brands. They have so many brands. You'll see some of them in a minute. I would say, in terms of the largest issue with something this, what could Procter & Gamble face that could hurt the business? It would be store brands. It would be Amazon brands. I'll tell you, for example, when we use batteries around the house, we just buy the store brand from Amazon. Now, that being said, companies like Procter & Gamble, they could power these store brands. And so Kirkland brand, for example, in certain areas, maybe Costco partners with Procter & Gamble to produce those brands. And so it's not only a black or white, if you will, situation. There's shades of gray. And it's one of these things where white labeling or store brands, it's not necessarily the demise of companies like this. And I think all the companies can win. Now, there are so many products that Procter & Gamble makes. I'll tell you, one of them is just the Gillette brand of products. And so there's some Gillette shaving cream right there. What else do they make? Another one is these Charmin brand of toilet paper. And so they have their hand in so many consumer packaged goods niches. And you'll hear people say from time to time, my name is PPC Ian, but people oftentimes call me CPG Ian because honestly, that's a sweet spot of my portfolio. I'm very heavily weighted in consumer packaged goods. What else? Here's some just Tide products, washing machine cleaner. The Tide laundry detergent is very good as well. And so they have a stronghold in the laundry department. And as a parent of 2 kids, I just know how much my wife and I are doing laundry all the time. And so the Tide products are in heavy rotation in our home. And then Crest as well. They have a very, very strong hold in the dental care arena. And so this is the Crest Complete with the scope whitening. And so Procter & Gamble is honestly in so many different places. And that's why their market cap is so large. The scale of the business is so large. I love the company. I absolutely do. And it's a global company as well, which is so important. Let's keep going. I want to move on to the next one. Let's talk about Coca-Cola. So let's start the metrics. Check it out on the screen right now. And so Coca-Cola is number 8 and number 8 out of 50 of my favorite dividend stocks of all time. Coca-Cola is a CPG food company. It's trading at a PE of 23.72, which honestly, in the scheme of things for Coca-Cola, that's not too bad. Coca-Cola is a company that tends to trade at pretty rich valuations. I highlight the dividend yield of 3.3%. I think that's a fabulous starting yield. And payout ratio is a little higher, so I don't know how quickly they're going to grow their dividend over time. And so with Coca-Cola, I would say let's get into the props a little bit. One of the things that I love is they now have this Coca-Cola with coffee. We have one single can in our house. I haven't had soda for a few years now. Personally speaking, as someone who does have acid reflux, I try to stay away from those types of beverages, although I am someone that loves soda. I'm going to make an exception and probably share this can of Coke with coffee with my wife because it looks so delicious. I'd say one of the things I love the most about Coca-Cola is they're getting creative. They acquired Costa Coffee, which is a wonderful coffee franchise in the UK and in Europe. And they're just getting innovative with new drinks like this. And I think this could be a game changer because just as a parent with 2 kids, I realize that I can't make it through my day without some caffeine, without some coffee. And so another prop is just Diet Coke. Everyone knows all about Diet Coke, known all around the world. What a brand. And so I would say with Coca-Cola, what are some of the risk factors? I would say it's consumers getting more conscious about sodas and starting to move away from sodas. And so can they make up for that through other types of beverages? Pepsi, for example, has gotten very smart with their bubbly water and their Izzy sparkling fruit juices, and can Coca-Cola get away from it a little bit with things like this? And we'll see about that over time. But I love Coca-Cola, and that's why it's so high up on the list, but not quite as high as PepsiCo. With that, I want to share my first industrial of the day. I love owning industrial companies. I love diversifying across all different types of industries. I'll get into a lot more industrials later in the video, but the one that ranks really highly on my list is 3M. They make this 3M Scotch tape, but they also make so many different products, tens of thousands of different products. And there's this kind of saying that you're never more than a few feet away from 3M because 3M is just embedded in everything. Even like those orange cones that are sometimes out on the street or blocking traffic or at a construction site, the materials, the reflective material on that is oftentimes provided by 3M. So you're always near 3M. It's literally everywhere. If you just look closely enough, you're going to find 3M. And so I love that about 3M. And let's go check it out on the screen right now. So these are some metrics about 3M. It's trading at $189. This is one of those stocks that I spent the better part of 2020 acquiring. And despite analysts saying, hey, this company is not going anywhere, hey, this company is going to face a lot of problems, I took that opportunity to keep buying. I highlight the PE ratio of 19.76 on forward earnings because I believe that PE represents still a solid value for 3M company. I highlight the dividend yield of 3.1% because I believe that is still a solid starting yield. And so I think at a payout ratio of 61%, they have a lot of room to grow the dividend over time. And so that's something that is wonderful. And the market cap isn't too big, so this will probably be a company that could grow a little bit quicker over the long run. And the thing I love the most is the diversified product mix. The thing I like the least is that could 3M face a lot of competition on the types of products they produce from countries like China? There could be globalization, global competition for a company like 3M. So that's something we have to keep an eye on. With all of that, I want to keep going. I want to talk about Raytheon Technologies. It's back towards the top of the list. And so check it out on the screen right now. And so Raytheon Technologies is a defense company. The price per share is $76.92. PE ratio is at 20. Payout ratio isn't so bad at 50%, so they have room to grow that 2.5% yield over time. I would say Raytheon Technologies used to be really high on my list. It used to be number 4 favorite company when it was United Technologies, and it included OTIS and Carrier. But now that they spun out OTIS and Carrier and United Tech merged with Raytheon, became Raytheon Technologies. It is a little bit lower on my list just because I prefer it as the combined conglomerate company. But honestly, by splitting up, they have unlocked a lot of share price and capital appreciation value for shareholders. And so I would say with Raytheon Technologies, what do I love the most? Well, I think it's important to have some element of diversification in my portfolio across different industries. And so for someone's portfolio who is largely focused on CPG, consumer packaged goods, I like having a defense company in the portfolio. What do I dislike about Raytheon Technologies? I would say they are largely going to be dependent on the government as one of their main customers. And so government purchases can fluctuate over time. And so that's something to be aware of with something like a Raytheon Technologies. And so moving on, you knew this was going to have to come up sooner or later. I got my mocha right here from Starbucks, my iced mocha. And today I just got the tall because I had already had a coffee earlier in the morning, and I just can't have too many of these, but I need a break here. Oh man, these are so good. And so, you know, if you've been around a while, smash that like button if you like Starbucks as much as I do. But I was buying Starbucks so many times last year. I'm glad I did because this year it's really expensive, but I still love the company. And so check it out on the screen right now. Let's talk about Starbucks really quickly. This is a restaurant company. Note, I don't put real estate. It's not as much of a real estate play as McDonald's. We'll get into that in a minute. It's trading at a forward PE of 37.88. That's what I'm talking about in terms of cost. And the dividend yield is lower at 1.7%. Payout ratio is at 63%. Market cap 126 billion. So I would say historically, this company has increased the dividend very, very quickly. I'm not so sure it's going to grow at the same rate of increase over the next few years because the payout ratio is getting higher. That being said, this is a growth company. It is a company that's growing very, very quickly. And as a dividend investor, one of the things I want to be very careful about is not underperforming the market. One of the things I want to be very careful about is not having all utility stocks for that matter, because I want to keep pace with the market while having over allocation to passive income, to dividend yield, having dividend yield be a larger component of what I'm doing. But that being said, to keep up with the market, to perform very well, I need those faster growing companies like Starbucks in the portfolio. And so that's what I love about it so much. I would say what I also love about Starbucks is that it does focus on technology. They focus on agility. They appeal to many younger generations. When I go to Starbucks, I see the younger generations, and it future-proofs my portfolio in some ways. What I don't like about Starbucks is it's different than McDonald's. They don't own the restaurants the way that McDonald's does. I'm sure Starbucks owns some of the land, but when I've looked through their balance sheet, when I've looked through their annual report, it's not to the extent of McDonald's. And so it just is a different business model from that perspective. It is more of a restaurant with a lot of technology behind it. That's how I look at it. And so the next one, you've probably been waiting for this as well, Kleenex. And so the next one on the list is Kimberly-Clark. This is a slower growing company. And so to compare and contrast this with something like Starbucks, which is growing really quickly, Kimberly-Clark, it's growing a little bit slower, but it provides a ton of dependability to my portfolio. Yet another consumer packaged goods brand, just like I discussed about with Procter & Gamble. But you know I love that stuff. And so with that, check it out on the screen right now. Let's go through Kimberly-Clark. And so Kimberly-Clark is currently trading at a forward PE of 16.99. In my humble opinion, it is in a very, very value oriented position right now. I think it's a good time to buy Kimberly-Clark. I recently bought some Kimberly-Clark. If it stays down at this range, I'll buy more. Dividend yield I highlight because it's a 3.4 starting yield. I love that about it. It's a smaller company at 44 billion, so I think it has a lot of room to grow. Payout ratio not too bad, just under 60%, so there is some room to grow that. And I would say what I love about Kimberly-Clark, honestly, is we all need toilet paper, but even above and beyond that, the Kleenex brand is good tissue. But one of the other things I'd say is, as a parent with 2 young kids, we've tried all the different diapers. And we found for our family, at least, that the Huggies brand of diapers are the best diapers. And I'm talking, we've tried the organic ones. We've tried the ones from Procter & Gamble, the Pampers, we've tried all of them. And I would just say for our needs, Huggies has always been really good to us. And so I like that about Kimberly-Clark, that I'm supporting the very brand that I invest in. Now, what I don't like about Kimberly-Clark is the same thing that I said about Procter & Gamble, is this idea of the store brands. And the store brands, though, could be powered by Kimberly-Clark, but whenever it's a store brand, Kimberly-Clark is going to make less margins on that. And so can Kimberly-Clark thrive in an era where there's going to be the Amazon brand, there's going to be the Kirkland brand, and there's going to be the Kleenex brand? That's something that we will tell over time. Personally speaking, I believe all of them can thrive. Now, with that, I want to move into yet another CPG oriented company. Let's talk about Unilever. And so here's the Dove soap. Shout out Dove soap, sensitive skin, my favorite. Gotta keep fresh and clean for all these YouTube videos that I do. Gotta look good while I earn my dividends. And so I love Unilever. Let's talk about that. Check it out on the screen right now. And so Unilever is number 13. It's a CPG and CPG food company. They do food and they just do consumer packaged goods. I really love that this is a global company based out of the UK with Dutch and British roots. They have a huge beauty products portfolio, as I just showed you. I love Dove soap. Dove soap is the bomb. Now, what I would say is it is a little bit more difficult to analyze because of my US-based experience and so my US-based expertise. And so looking at something like Unilever can take a little bit more time for me. Right now, it's trading at a PE using trailing 12 months. I couldn't find forward on this of 22, and so it seems to be trading at a fair level with a 3.4% starting yield and a 75.5% payout ratio. I don't know how much they'll increase the dividend, but it's a nice starting dividend for sure. All right, you knew this is Thug Life Investing as well here. And so shout out to the OG Thug Life investors. Put a comment below, hashtag Thug Life Investing if you're a Thug Life investor like me. We had to get here sooner or later. I want to talk about number 14, and that is Philip Morris, ticker PM. Now, this is a sin stock company, and so a lot of people don't like investing in it. That's the thing I like least about it right now is, honestly, just society's perception. They hate this thing. But anyway, it has great metrics, and I like Philip Morris in terms of all the sin stocks because it's a pure play international play, so it doesn't have to worry so much about the political landscape in the United States, which sometimes can be kind of difficult for these types of companies. Anyways, it's trading at $89.98. PE is 15, which is awesome. So I highlight it. 5.3% starting yield, which is awesome. So I highlight it. Payout ratio is higher, but that's by design. They want to get the cash out to the shareholders so that the government can't come in and try to take it from them. I love that this company is sheltered from the U.S. politics, and I love the strong results with the IQOS product in Japan. And I think that's going to just be a breakout product for this company. And the thing I don't like about it, obviously, is it's a sin stock. So with number 15 is the Home Depot. I don't have any props. I wish I did. I actually have a big bucket, but I am in a confined space here where I just can't fit all the props. But check it out on the screen right now. You all know the Home Depot. This is my favorite retail company. And this is a big retail company with a $300 billion market cap. It's a little expensive at a PE of 22, but honestly, it's always growing so quickly. I kind of look at this one like Starbucks. It adds a lot of growth to my portfolio. This thing is amazing. It's just a powerhouse. PE ratio, 22, dividend yield 2.3. Payout ratio is only 51%, so it will grow the dividend as it has. The dividend increases with this one. Boy, they're always so big over time. The dividend increases, you just always look forward to it because Home Depot, they don't disappoint someone like me. They never do. Now, homeowners, they can't live without it. And so if you're younger and you're watching this channel, shout out. I know I got a lot of old school people like myself as well, older people. And you're a little older like myself. I'm going to tell you something. You have kids, you own a home, you're going to find yourself at Home Depot almost every weekend, whether you want to be there or not. And so at a certain point, you just want to invest in the stock. That's what I love about it so much. What I would say is a large issue, not necessarily a large issue, but could this home renovation boom last forever? Right now, interest rates are really low, so all kinds of people are buying homes. And with the pandemic, a lot of people have been home, so they want to renovate their homes, invest in their homes. Will it last forever? I don't know, but I kind of think that, something like Home Depot, again, as a parent, whether there's a pandemic, whether there's a renovation boom or not, I'm there like all the time. And so with that, that's Home Depot. I want to go on to the next one. So the next one, honestly, what do I keep looking down at when I'm doing these videos all the time? It's this. Can't live without my Apple products. And so I also got another prop. I got the old school USB mouse here as well. I love this one. And so this is kind of older school, but I got a few props. And so I can't do my job without Apple. I can't film these videos without Apple. I can't crunch numbers without Apple. I just love Apple products. I'm an Apple fanboy through and through. And so this is one with a lower dividend yield. But like I was saying earlier, I don't want to underperform the market. I want to keep up with the market while providing a disproportionate amount of dividend income and possibly even beating the market. Because when I backtest this 50 stock portfolio over long periods of time, it has tended to beat the portfolio when I did my back testing. And I'll share a link to that analysis in the video below or in the description below. Now, check it out on the screen right now. Let's talk about Apple for a minute. It's a technology company. And so finally, we're in technology. I guess you could call all of these technology because they all use technology to certain extents. Kimberly-Clark is using technology in their warehouses with drones to survey what they've got. Obviously, Starbucks has their app, but Apple is pure play. And so PE of 27 right now, I honestly look at that as a great PE for Apple. I recently bought some. Starting yield is only 0.7%, but they're going to grow it. Payout ratio is so ridiculously low. They have a lot of room to grow that dividend over time. But for someone who needs dividend income right away, this isn't going to do. For someone like me who can wait 10 years for a high yield on cost, it will do. $2 trillion market cap, this thing is huge. What I love about it is broad-based technology exposure to hardware, microchips, software, services. I'm future-proofing my portfolio. What I don't like as much is the low dividend yield. And so as I move into company number 17, this one I would say is also a technology company in many ways, but it is classified as an industrial company. But I look at it as tech because they're really heavy in quantum computing as well. By the way, I have another YouTube channel, just a side project on cryptocurrency, earning cash flow from cryptocurrency. I will link to that in the pinned comment below if you want to check it out. And one of the risks to cryptocurrency is the very things that this company is working on, quantum computing. Check it out on the screen right now. Let's talk about Honeywell. So Honeywell is an industrial. I love this company. It is pretty expensive here at a PE of 26.92, but honestly, it's never cheap. Dividend yield is 1.8%. Payout ratio is really low at 47%. And there's a lot of room to grow that dividend. I like that it's an industrial with a tech focus. I like the exposure to quantum computing. The largest issue, in my humble opinion, is it always trades at expensive levels. I can never get this thing on sale, and so I end up just buying it at expensive levels. But it's one of those stocks where I'm looking about it not just for myself and my wife, but looking generationally, looking at my kids' future as well, and kind of building up a portfolio that weathers the test of time. I need something like Honeywell in it, just like I need Apple. With all of that, we're doing Thug Life again. Let's talk about Altria. Check it out on the screen right now. And so number 18 is Altria. This is a SIN stock. It's trading at a PE of 11, which I love and I highlight. Although it is up, it's gone now from 39 to 51, so it's slowly creeping up there without anyone taking notice. I love the starting dividend yield of 6.7%. I love the payout ratio of 75%. They're targeting 80, so they're going to grow this dividend. And it's always undervalued. It's always dependable, even when they have something really bad happen, like a Jewel acquisition, which just totally failed. They always seem to recover. It's a SIN stock, though, in terms of my largest issue, with 100% U.S. exposure. Oh, my God. Talk about serious political risk with this thing. And so that is the downside of Altria and why it is not as high on my list as Philip Morris. But for those who have been around here a while, most of you know, I got my start in SIN stocks. That's how I started with dividends, and I branched out from there. But now you can just call me CPG Ian or PPC Ian. Let's keep going. I want to talk about another regulated electric utility, Southern Company. Check it out on the screen right now. Number 19 is Southern Company. It's trading at a starting yield of 4.3%, payout ratio of 77%, PE of 17.98. Southern Company is just a great company to own for dividend yield right now. I use dividends right now. I use dividends to pay bills right now. And so a company like Southern Company, I can buy shares today, start earning cash flow, good cash flow tomorrow to pay my bills. Let's keep going. Next one is ABBV. Check it out on the screen right now. I bought some ABBV this week. I bought some ABBV last week. I'm buying ABBV now. And one of the things I like about going through all 50 stocks is that I can really dig into each of them and understand what's going on with each stock at any given time. So if you own a portfolio like I do of 50 stocks, I encourage you to do the same exercise I'm doing here. It really illuminates a lot. PE ratio at 8.5%, doesn't get better than that. Dividend yield 4.9%, doesn't get better than that. Payout ratio of only 41%, doesn't get better than that. I love the incredible value and growth. I love the 17.9% 5-year compound annual growth rate on the dividend. And I love that they successfully integrated the Allergan merger. Wow, this company is just pulling stuff off. What I don't like is the debt load. But interest rates are low, so whatever. And what I also don't like is government potentially coming in, interfering, trying to mess with their pricing models. And so that's something that could potentially hurt ABBV. With that, let's go to CPG food again. And so I'm jumping around to different categories. I like that because I like representation from all the categories. And I hope you see as I go through this, I've got global exposure. I've got exposure to different size companies. I've got exposure to different types of companies. Let's talk about this. Anyone out there who has a young child, has a baby, you know about this. Pouches. Plum Organics. These pouches are the gold standard of pouches. What has this one got? Kale, corn, carrot, and tomato. Young kid, a baby, needs a healthy snack. Plum Organics. Who makes it? Campbell's Soup. What else have I got here? Campbell's Soup. Tons of salt. How much salt in here? I don't know, more salt than I can count. I love it because I'm a runner. I go on 7-8 mile runs, and when I am done with it, I will guzzle a Campbell's chicken noodle soup to replenish my electrolytes. Let's keep going. Check it out on the screen right now. Campbell's Soup. Oh, 16.62 PE. What? This thing is an amazing value right now. Starting dividend yield of 2.9%. Payout ratio of 48%. Oh, a small market cap right now. I love this company. I love buying this company right now. What I love about this company is they successfully turned it around following a lot of bad years, bad management, bad acquisitions. Now they're well positioned as the second largest player in salty snack foods. They own Pepperidge Farm, Goldfish. Love it, just behind PepsiCo. What I would say is the largest issue facing Campbell's at this point is, can they keep up with PepsiCo and going direct to consumer? Can they keep up with Utz Brands Inc., which I'll talk about later, which is going direct to consumer, getting really innovative? This company not only needs to shed the bad acquisitions they made, but they need to get really innovative on technology and marketing. And so I hope they can do that. Let's keep going. Check it out on the screen right now. And so the next one I want to talk about is Air Products and Chemicals, ticker APD. This is a chemicals company. I'm going through all the different industries. This one has been one of the companies that has performed better for me than almost any other company I own. It has just skyrocketed in terms of capital appreciation. Now I invest for dividends, so capital appreciation is not the most meaningful metric for me. In fact, I like my stocks to stay lower. That being said, it feeds the ego and total returns are awesome. This one is expensive now at a PE of 30, not buying it here. Dividend 2.2%, payout ratio 66. But it always seems to be growing just exceptionally. The largest issue is its price to perfection. And so I don't necessarily see here buying it right now just because I don't see it as a value. And honestly, one of the things I'd say about Air Products and Chemicals as well that I see as an issue that's more specific to me is I own 50 stocks. I don't know or understand this stock as well as my others because I haven't taken the time to dig into it as much as the others. And so that's something on my to-do list. Nonetheless, I've owned it for many years and it's gone through the roof with me. Next one, let's go back to CPG. So we're talking about chemicals. Now let's talk about toothpaste. Colgate, man. I love this company because Colgate provides great dental care. My dentist recommended this one to me, and so I'll probably move from Crest over to Colgate. In fact, I have been using Colgate now last few days. I love it. Really good product, the sensitive one. Anyway, with Colgate, this is an international, global company, and most of their sales come internationally. That's one of the things I like the most. One of the things I like the least is this company is growing a little bit slower, and so it's sluggish growth. So I need stuff in the portfolio like Air Products and Chemicals to make up for the slower growth at Colgate. But they all play a role on the team, so check it out on the screen right now. Let's talk about Colgate. CPG, all day, every day. Starting yield is 2.4%, payout ratio 54%. There's some room to grow the dividend. Hey, I like that the PE is at a 23 right now, and so that's pretty cool. And so anyway, huge international focus. It's stable, but boy, is this thing just growing awfully slow. All right, we're already up to number 24, not even halfway. So I got to keep going, everyone. So let's talk about General Mills. They make this Annie's mac and cheese. I love this product. And someone was shaming me for eating this for lunch. Look, there's only 220 calories. I eat this, some carrots, maybe a piece of peanut butter bread or something. It's a quick lunch on the go. Nothing wrong with that. Don't shame me, y'all. I love General Mills. This is a company that owns foods, like Cheerios, for example. They also do pet foods. They bought the Blue Buffalo company, and that's going really well. And so check it out on the screen right now. Let's talk about it. The PE is a 16. This is a company on sale right now. I really like this company, much the same way that I like Campbell's Soup right now. Very good value. Starting yield 3.3%. You see a whole lot of highlighting here because all of this is good value territory. Payout ratio is low. They have room to grow the dividend. dividend. I should have probably highlight the market cap too, because it's low, room to grow. Successful Blue Buffalo acquisition. Everyone loves pets now. Blue Buffalo is a premium pet food company. They increased the dividend recently ahead of when they expected to do so. And so that's something wonderful. It means the Blue Buffalo debt and acquisition is going better than they even thought. Exceptional value. I would say the largest issue is in some of their lines of business, like Cheerios, for example, some of their foods, maybe it's growing a little bit slower. And so this is a company that has some slower growing business units, some faster growing. In terms of growth, let's talk about a CPG company that's facing a ton of fast growth. This is one that I just started buying this year in 2021, and this is Church & Dwight. Church & Dwight is best known for their Arm & Hammer brand baking soda. And so this is it right here. I love this stuff, and so very good to have around the household. Also, they make OxyClean, something else really great to have around the household. Church & Dwight owns a lot of different brands. It's kind of like Clorox companies in many ways, but it's growing a little quicker than Clorox, and it's priced a little higher than Clorox. So check it out on the screen right now. And so with Church & Dwight, it's trading at $84. PE is 27. Starting yield is really low, but that payout ratio is low as well. And so there's a lot of room to grow Church & Dwight. And market cap is only 20 billion, so there's a lot of room over time for this company to grow. Did I mention it's a high growth company? And so I would say with Church & Dwight, the only downside I would say is probably it's a bit more expensive here. So it's kind of like one of those companies like Honeywell. It's always more expensive to buy. All right. I want to talk about the next one, and the next one is something that was probably my biggest takeaway from this entire video, which took a lot of time to film and produce. Check it out on the screen right now. I want to talk about Pfizer, the original company that came out with the vaccine for this pandemic we all went through. I love this company. What's so exciting is I haven't really been looking at Pfizer because when I own 50 stocks, it's hard to pay attention to every stock all the time, and I didn't realize Pfizer is trading at a PE of 10. So right now, Pfizer is really cheap. Starting yield is 4.3% and payout ratio is only 47%. So there is a huge amount of room for Pfizer to grow the dividend. There's a huge amount of room for value here, just buying at these levels. I kind of look at it like AbbVie. I think pharma's under a lot of pressure right now. And I think one of the reasons pharma is under pressure right now probably is because just people worried about government politics. They had a successful Upjohn spinoff. Talk about that a little bit later. That's one of the things I like about it. They're positioned really well right now just to focus on growing their pipeline, growing their portfolio, coming up with some new drugs and growing the company. I think that would be great because they spun off the generics. One of the things I don't like about Pfizer and AbbVie for that matter, not as much J&J because J&J is more diversified, is this pure play pharma type business. These patents only last 20 years, which is not that long. You've probably been waiting for it, so let's talk about the next one, another salty snack food company. You know I own Pepsi. You know I own number 2, which is Campbell's Soup. Number 3 in the category is this newer company, older company, been around forever, newer to the public markets, called UTS. So man, are these chips good. UTS brand. I love UTS brand chips. Here it is. And you may not know, but they also own Tim's, which brings this beautiful, beautiful Hawaiian brand of potato chips. I cannot get enough of these. Did I mention I like salty snack foods? Hey, I'm a runner. I'm a swimmer. I need my electrolytes. I need to restock on all that salt that I sweat out when I'm exercising. Check it out on the screen right now. So this is my number 27 favorite dividend stock of all time, Utz Brands Inc. The PE is a little misleading because they have a lot of depreciation right now because they're in growth mode and they're growing through acquisitions. So that's something for all of you to keep in mind. Dividend yield is really low at 0.8%. Payout ratio is 30%. Look, this is a small cap company that went public via SPAC. It's in hyper growth mode. And so the fact of the matter is this is something that brings a lot of growth to my portfolio. I wouldn't be surprised if UTS is worth $10 billion when I look out 5, maybe 10 years from now. This is a company that will continue to grow the dividend. I love it. And so they also bought Truco Enterprises on the border chips, which I love. Now, the thing about UTS is it is priced, a little high. And so there's expectations out there that it will continue to grow. And so in terms of a downside or con, if you will, of owning this position is, can it keep growing? It has to. It has to, given the valuation. Let's keep going. I got a lot of ground to cover. Check it out on the screen right now. And so the next one I want to go through is Norfolk Southern. This is a railroads company. Boy, has this one been one of the best performers that I own. I have made a lot of money on Norfolk Southern, much more than I ever thought I would. Dividend yield is only 1.5%, but the payout ratio is low at 35%. And I've just made a ton of capital appreciation. It consistently surprises me. I love that. I love that they also have all these easements and all this land associated with it. That's something these railroads have been around since the beginning of time. In terms of a large issue, could they get disrupted by long-haul electric vehicle trucking? Maybe they could. And so that's a potential risk. Now, what I would say is with all of these kind of on-demand delivery services, ordering stuff on Amazon, everyone needs the trucks and the railroads. And what I would also say is there's certain things like oil, there's certain things like lumber, there's certain things like just rocks and building supplies that they're not going to go on long-haul trucking. That has to go on the railroad. And sometimes even automobiles, for example, are delivered via the railroad, heavy stuff. And so I think there's a use case for the railroad and for long-haul trucking. I think they could all live in synergy and do well, but a lot of people think that railroad will demise because of long-haul electric vehicle trucking. Let's keep going. Check it out on the screen right now. I want to talk about number 29. We're getting there. More than halfway at least. Bank of Montreal. This is the first financial company that I talked about today. Price per share is $88. PE, honestly, is a little low, 13. I like that. Starting yield, 3.8%. I like that, too. Payout ratio is only 49.5%. I would say it's a reasonable valuation right now. And what I love the most is there's this overall perception that Canadian banks are the strongest banks in the world. I would say in terms of downside, what's one of the things I don't like as much about Bank of Montreal is I'm familiar with cryptocurrency. I'm familiar with fintech. I'm familiar with some of these disruptions happening in DeFi. I've spent the better part of the last month educating myself on them. And I think traditional banks are going to have to adapt or they will face a demise. And so that's a risk factor for something like Bank of Montreal. Let's keep going. Check it out on the screen right now. Number 30, favorite dividend stock of all time is none other than Walmart. I like Walmart the most because I think it's the only company really in retail that could go head to head with Amazon. And so it's a retail giant and it brings retail exposure to my portfolio. I like that the payout ratio is lower at 40%. I would say it's fairly priced, though, here at 24. I'm not buying here, and the dividend's a little lower. It's a really long-term play. I think this company at this point isn't really focused on dividend growth as much they are focused on scaling their business, competing with Amazon. But that's what I love the most about it. It brings growth to the portfolio. I would say in terms of the largest issue with something like this is just very slow dividend growth. So what I want to go into next, and I'm really excited about, is a newer position that I started adding in 2021. I want to talk about Hormel. You may not know, but Hormel Brands just acquired Planters peanuts and nuts from Kraft Heinz. And so that's a brand that I think I really like. These are the heart healthy ones. These are great peanuts here. And you may not know, but they own Skippy peanut butter, my favorite peanut butter, the bomb. And so that's Hormel. Let's go through some metrics. Check it out on the screen right now. And so with Hormel, it's trading at $48. It's a higher PE. It's trading at a PE of 27. Why is it so high? Because the company is growing very quickly, just like Church & Dwight. And so that's something I love about Hormel. It brings some of that growth to my portfolio. Every different stock in the portfolio plays a different role, and Hormel certainly has a role on the team. Payout ratio is 56%, dividend 2%, market cap is lower. What I love is all the brands, the fast growth. It has a incomparable, amazing balance sheet. I would say one of the largest issues with Hormel is Hormel's roots are in meats. And what's going to be the future of meat with new companies like Beyond Meat trying to make products that taste like meat but aren't meat? And so with the population of the world growing, what will be the future of meat? And so that's something to think about with Hormel. But I love Hormel. It's a great company. I keep buying more. Next one, I have a kids toy company. I want to talk about Hasbro. Here's my son's Incredible Hulk. This is just one of the many figurines that he has from Hasbro. So Hulk smash. Please smash the like button, just like Hulk. If you're enjoying the video so far, check it out on the screen right now. I haven't talked about Hasbro forever, but I love it. It's a consumer discretionary. It's one of those companies that parents just love because it keeps kids off of these screens and playing with more traditional toys, although they have gotten into internet games. They have Magic the Gathering, which is something I love about Hasbro. In terms of nerding out, I used to play that game when I was younger, and so it's all good. PE is 22. Dividend yield 2.8%. I would say Hasbro is usually more expensive than this, so it's kind of at a better place than it has been. I would say payout ratio is not so bad. It's 62, 13 billion market cap. I love it. What I love the most is Magic the Gathering. It's an awesome game, and the fact that they're bringing these games online is awesome. I think in terms of the largest issue, Can Hasbro continue to evolve? As someone that's been investigating the blockchain quite a bit, I came along a blockchain called Decentraland, and you can buy this mana coin, and what the coin allows you to do is convert it into land and purchase land and other items in the game. And so it's this interactive game that lives on the blockchain, and this is really unique, really innovative. And I think if Hasbro wants to continue to compete both with traditional toys, but also with all the growth they're seeing with their online segment, they need to continue to up-level the game and learn from things like Decentraland, because I think that is the future. And I think at some point in the future, taking a side tangent here, but you hear all this hype about NFTs and why people are paying $69 million for NFTs. At some point in the future, it may be 50 years from now, maybe more, there's going to be augmented reality. And even, for example, humans might even have microchips in them. Who knows? I'm not saying, by the way, I agree with this. I'm saying as an investor, I have to look at what's going to happen in the future, and I have to understand the trends. But what I'm saying is, why would people pay all this money for these expensive digital NFTs? Well, in the future, we might all have digital homes. We might all have digital houses. It might live in our mind, and we can surely hang up those NFTs in the houses. And so I'm just saying, if people at Hasbro aren't thinking that far ahead, that's a potential risk for the company, because there's some wild stuff around the corner. I'm not saying I agree with all of it, but what I'm saying is I'm trying to understand it so I can invest, because I'm an investor. Check it out on the screen lights right now. Let's keep going. I got to go fast. And so next one is Leggett & Platt, another industrial. This one has gone down my list over the years just because they're in like the bed springs and furniture for offices and hotels. And we all know with the pandemic, those aren't the best industries to be in right now. I am absolutely staggered and just excited to see this trading at a PE of 18. I'm surprised the PE isn't really bad. The fact that the PE is this good tells me the company's earning a lot of money despite these challenges out there. And so dividend yield is good, 3.5%. And so I'm just surprised. What I love most about them is how the heck are these guys rebounding given the huge amount of business they do in furniture, springs for offices and hotels. And I would say what worries me the most about this company is global competition from China. It's a cutthroat world out there in terms of competing for things like bedding, bed springs, furniture. But so far, Leggett & Platt has done really well. Let's keep going. Check it out on the screen right now. Next one, OTIS, spinoff from United Tech. I like OTIS. It's number 34 on my list. It's done really well for me. This is one that's given me a lot of capital appreciation. And so I guess United Tech did the right thing with the spinoffs and all. But I'm not buying OTIS here at a PE of 24. Payout ratio is almost 30%, so there's room to grow the dividend, but that's a small dividend at 1.2%. What I love, it's one of my best performing stocks. It's a key example of why I don't sell spinoffs. I learned from Peter Lynch, don't sell spinoffs, because spinoffs can often do really well. I think it's fully valued, so I don't know how much more growth is ahead. On that note, I want to talk about CARR as well, the other spinoff from United Tech. Check it out on the screen right now. I don't sell spinoffs, just like Peter Lynch told me not to. I'll link to Peter Lynch in the description below. I have some videos about him and the lessons I learned from him. Greatest investor of all time, in my humble opinion. CARR is another one. It's performed exceptionally well for me. PE at 21, dividend at 1.2%, payout ratio 25%. Maybe I'll buy a little at some point, but it's not really top of mind for me, but I'm surely holding it. It's one of my best performing stocks. Same story as OTIS. And so with all of that, I want to get into another sin stock, because I'm all about the sin stocks. I want to talk about British American company, BTI. They are the only really global sin stock anymore, because Altria, Philip Morris are segmented by geographies. BTI is global, and they bought out Reynolds American, which was a stock I used to own. Very, very strong company. Let's talk about it. Check it out on the screen right now. I like owning sin stocks because the dividend yield is really high. Even though this one has rallied a bit, the starting yield is still a 7.5%. PE is 11 based on 2020. I had to look backwards for this because I don't have forwards EPS estimates on this. And so payout ratio is high, but that's understandable for an industry where they're just trying to get cash out of the company and to the people who own it. So government can't go after it. Largest issue, obviously, it's a sin stock. I'm sure there's a lot of people watching right now that just don't like sin stocks. They don't want to own it. They don't feel comfortable owning it. I would say that's okay. We are all different in our journeys. I'm trying to diversify away from sin stocks because I don't want too much exposure to sin stocks. And I've been doing really well at that over the years. I'm trying not to buy more sin stocks or reinvest dividends. I buy once in a while, but not too much, because I want to diversify away, because there is risk with sin stocks. And that's why they are trading always at such low price earnings ratios. Let's keep going. Check it out on the screen right now. Another financial company, Chubb. This is a a insurance company. And Chubb, it's never going to really outperform the index. And so that's something you've got to know about Chubb, but it's always kind of a dependable company. Buildings, property, it's got to be insured. You've got to insure it. Even if your property is empty and you can't rent it out, it better be insured because you don't want to lose the value of that real property. And so I like owning Chubb. I did a large analysis on all these different insurance companies. It's the best one I could find. And dividend yield is low at 2%. Payout ratio is low though too at 26%. So there's room over time to grow it. What I love the most is P&C insurance is a must. You just have to buy it. What I don't like is it's a slow grower. It's a really slow grower and it's never going to outperform the index. But again, on my team of dividend stocks, every different stock plays a role. Let's keep going. Check it out on the screen right now. Caterpillar. This one is growing really quick, and I'm not buying it here just because it's gone kind of out of reality. It's trading at a PE of 27. Dividend yield is really low. Payout ratio is low too, so there's room to grow it. But what I love the most is this is the company, one of the companies that's kept my portfolio doing so well because it's provided that capital appreciation to keep it performing well. Whereas some of my stocks are just underperforming the index because they're not even meant to outperform the index. They're more bond-like proxies, like utilities, for example. They're like bonds. This one's done well on capital appreciation. What I don't like about it is I would say it's overvalued. It's run up too quickly. It's very cyclical. I think it ran up a lot because someone was telling me that ARK Invest, Kathy Wood, is all about Caterpillar. And so, hey, Kathy, thanks for the capital appreciation, but I can't buy more of it here. But I own it. It's one of my 50 favorite dividend stocks of all time. I won't sell it. Largely speaking, I don't sell stocks. I can't foresee myself selling any of these 50 stocks. Let's keep going. Check it out on the screen right now. And you can see as I go down this list, I'm a little bit less excited. I love all 50, but I share the best to the worst of my 50. Next one is PPL, utility company, regulated utility. Trading at a PE of 11, gotta love it. I'll probably buy some just because it is trading at a discount. Dividend yield 5.7%. Payout ratio is pretty low. What I love the most is they successfully sold off their UK division for a great price. I just talked about this on my Patreon. Check that out. I'll link it in the pinned comment below. They're de-risking the company. I saw a lot of risk in that UK division. There's a lot of talk in UK that utilities, energy would get nationalized. I don't want to have that kind of risk. By the way, I love the UK, London, favorite city in the whole world. Shout out everyone watching from London. I think it's a solid value here. What I don't like about it right now is there's some risk. Without those earnings, boy, that UK division was profitable. Thankfully, they sold it for much more than they paid for it. They got a good deal. So that's good. But that UK division was profitable. They used the proceeds to buy a Rhode Island utility from National Grid, same people they sold the UK division to. But will it be enough to continue to pay the dividend? I just hope they don't pull a Dominion on all of us. Thankfully, I don't own Dominion. A lot of dividend investors got flustered because Dominion cut the dividend. Whole thing went down with Warren Buffett with them. Anyway, but I digress. I hope that doesn't happen with PPL, but it could happen. Talking about international stuff, now PPL is all US. One of the reasons I originally liked them was because of their UK division, but that's before I knew that UK could get nationalized. Let's go back to France. Paris, another one of my favorite cities in the entire world. Man, I wish I could visit Paris. All my French homies out there, please put a shout out in the comments below. I love you all. One of the best experiences in my life was when I was younger, before kids, traveled to London with my wife, and then we took the train to Paris. Wow, what an amazing amount of culture. I just love those two cities. Anyway, Danone, here's this Horizon organic whole milk. I love these because for an emergency, these are good to have because you don't have to refrigerate them. These are always good to have a case of these from Costco around. But you can see on the back here at the bottom, Danone makes it. And so I own Danone. Check it out on the screen right now. This is another CPG food company. I like this company because it's trading at a lower PE of only 14. Another good value. There's been some turnover there in management recently. And so I don't know as much about the company, to be honest, because it's harder for me to investigate and understand a French-based company, but I do my best. I have a lot more research to do there, but I own it. I love it. I've owned it for a long time. Payout ratio is low. They recently, to my understanding, cut the dividend a little bit. So you'll see lower on the list here as I get towards the tail end of my portfolio. Some of these aren't on my good list right now, even though I own them and I love them, just because I don't like a dividend cut, but I think the dividend will come back. They got some new management in there to my understanding, and I think it'll do well. What I love the most about Danone They make healthier foods, healthier options. Health is the future. Hey, to enjoy my dividends, I need to live a long time. So healthy is good. And I love that about Danone. What I don't like about them is they've been struggling for quite a few years now. So they really got to get things figured out there. They've been struggling. What I also love about them, by the way, is it's very international. They're based out of China and they do a lot of, based out of France, and they do a lot of business in China. And around the world. And so I love that about Danone. Let's go. Check it out on the screen right now. Next one, Universal. Another sin stock company, but it's a farming company as well. They farm the leaf that's used in Altria's products, for example. PE is 22. It looks a little high. I got to look into that more, but I don't think it's a real 22. There's probably something that happened in one of their recent earnings reports. I love the 5.3% dividend yield. What I love the most, it's farming exposure. There are people out there trying to buy up all the farmland, and I'm not so sure that those people buying up all the farmland have the best of intentions. I like to own some of the farmland so we can keep the farmland with the people, with the common shareholders. That's what I love about Universal. What I don't love about Universal as much is they do have a good debt load, and honestly, they're exposed to sin stocks. Let's keep going. Check it out on the screen right now. Next one is Hawaiian Electric. I've owned it forever. Shout out all my homies in Hawaii. I love you all. Another favorite place in the whole world. Probably just behind London. This is the small little utility in Hawaii that just seems to do so well all the time, and they own a little bank as well. I think it's the third or fourth largest bank in Hawaii. Dividend yield is 3.2%. Payout ratio is 73%. PE is richly valued. I love it because it's a niche regulated utility, been around since the 1800s. I can't bring myself, though, to buy it here. It is so richly valued, so I can't buy it here. That's why I don't like it. But I have a good sizable position in this one. It's treated me really, really well. And it shows you that sometimes the stock market can surprise you. I never would have thought that a utility company would perform so well. But HE, you guys have done it. Check it out on the screen right now. Let's keep going. Almost done. IBM, number 43. It's a tech company. Trading at a PE of 11, dividend yield of 5%. What's not to like? I love the low PE ratio, the strong starting yield. I love the fact that their patent portfolio is rivaled by few. They have so many different patents. What is the largest issue with these people is, will they ever turn this thing around? Revenue has been stagnating, flatlining for so many years. Can they finally get back on a growth trajectory? We shall see. That's why it's lower on my list right now. Let's keep going. Check it out on the screen right now. Number 44, Chevron, energy company. Energy is lower on my list just because energy has a lot of debt right now, had some really bad times with the pandemic, and I'm not so sure they can ever recover from what happened because of the pandemic, but I still own it because I diversify. I own all the industries, but I'm not really buying too much more energy going forward. Out of all the energy companies, Chevron's my favorite, has the best balance sheet that I've seen out of these companies. Dividend yield of 5%, so still reasonable dividend yield. I love that they're earning money. Again, I love that the price of oil is back up. With the advent of EVs, will it alter the demand for traditional oil? I think it could, but I also think traditional oil is used so many different places, like paving roads, like producing plastic, like air travel, for example. I think everyone can win. Space travel, we'll need some oil for that. So I think everyone can win. That being said, I'm not that excited about buying oil stocks right now, but I did buy some when they all tanked last year in 2020. Let's keep going. Check it out on the screen right now. Number one bank in Hawaii is Bank of Hawaii. I own this one. Strong little niche player in Hawaii. Fully valued, not really buying here, but it's performed well for me. Strong niche player. I would say the largest issue with them is, will regional banks be able to keep up with the innovations in fintech and DeFi? If I thought Bank of Montreal has potential issues keeping up with DeFi, how is Bank of Hawaii going to keep up with DeFi? So that's something we all have to keep in mind. Let's keep going. Another oil company, check it out, BP. I own BP. I like the starting yield of 4.9%. I like the PE at 14.4. I don't like that they have a staggering amount of debt. I don't like that, can they recover from that debt load and from that bad year that we had last year, that horrible year for these companies. And also, I would say out of all the oil companies, what I do like about BP is they really are thinking beyond petroleum. They're thinking about EV charging stations, and they've got some of those in place around the world. And they've been smart in thinking about transitioning from oil to other forms of energy. I think they're above potentially some of the other oil companies in that respect. Let's keep going. Check it out on the screen right now. I'm talking about number 47. Again, I'm getting lower on the list, so these ones I don't like quite as much, but Wells Fargo, it's a turnaround play. It has a really low dividend yield of only 1%. They cut their dividend, as did a bunch of the other companies I'm talking about as we get to the bottom of this list, I like that the PE is only 14. I like that it's recovered, quite frankly. I think that out of all the bank stocks I analyzed when I did buy this, pre-pandemic at least, it was a strong, fundamentally sound company that is turning around from some years of drama and issues with the fake account scandal. Now, what I don't like is, can they keep up with the changing financial system? And also, will their asset cap, will it ever get removed from being there by the government regulators? And so they have had some issues there, but it's a nice little turnaround play. I'm not really adding more here, but I do plan to hold it for the long term. We'll see how Wells Fargo does. Certainly, I'm speaking down a little bit to some of these companies at the end of the list, but maybe I shouldn't, because all 50 are valuable team players. And one of the things I'll say is, even when I own a company that goes out of favor, I don't like to sell it as much. I'll actually average down and buy more, because every stock has a role on the team. And I don't know all the time which industry is going to do well. I like exposure to all the industries, all the different types of companies. It gives me a well-balanced, diversified portfolio. With that, let's keep going. We're almost there. Check it out on the screen right now. Oh, boy. Royal Dutch Shell, another energy company. Nice PE. Finally, these companies have PEs again, because last year they had no PE because they were losing a ton of money. This is one that had to cut the dividend. It has a reasonable PE ratio. Price of oil's back. That's what I love about it. What I don't love is it has a lot of debt. And honestly, will it ever recover from last year? I don't know. Let's keep going. Number 49, I want to talk about VTRS. Check it out on the screen right now. I own this stock because it was a spinoff from Pfizer. The Upjohn unit got spun off, combined with Mylon. Now it's VTRS. I got to look into this because there's not a lot of good metrics out yet, because this company hasn't really put out any like 10Qs or anything like that yet, quarterly reports. But based on what I looked at, it looks like the PE is only a 4. But again, I got to verify if it's accurate. It looks cheap. No dividend yet. I think the dividend will come. Smaller market cap. What I love about it is these spinoffs, they tend to do all right. And it seems like it's trading at a fair value based on the limited data I have. The largest issue, honestly, is I'm not so excited about standalone generic biosimilar business, because that's a business that could have just a ton of competition. Now let's go to my last stock. This was originally a stock that was in my top 15. Now it's the last. Check out Cedar Fair on the screen right now. This is a master limited partnership. Again, I don't want to say like just because it's the last. Look how many stocks, publicly traded companies there are. This is number 50 of my top 50. It still means it's good, but the reason I put it last is right now there's no yield. They had to suspend the dividend. It will come back at some point, but it would be 7.7% if it got reinstated. Based on the current price, that's what the current yield would be. Smaller market cap. What I love about it is honestly their real estate. Even without their amusement park business, the real estate alone is worth a fortune. And the stock has performed better than I would have expected during the pandemic. It's rallied back up. What I don't like is it's losing money. Lots of debt. Will things ever get back to normal now that it has this huge debt load? It's kind of like the oil companies. Thankfully, because it's an MLP, I get to take advantage of some of their business losses because I get a K1 and that helps with my taxes, gives a tax advantage. So one of the good things about a real estate focused company losing money. There you have it, my top 50 favorite dividend stocks of all time. Please smash the like button if you enjoyed the video today. Please also don't forget to subscribe. And if you want more great content from my channel, I have, I think, 24 videos over on Patreon. Join 145 patrons over on Patreon. I will link to that in the pinned comment below. Boy, I am tired. This has been a long video. I hope you enjoyed it. Before I go today, please keep in mind, in terms of full disclosure, I own all 50 of the dividend stocks that I mentioned today. I am long all of those in my personal dividend stock portfolio. Also, before I leave today, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out, invest in the stock market or anywhere else, please consult a licensed financial advisor first. It's possible to lose a ton of money in the market. I'm just sharing my journey for pure entertainment. And also, it's not tax advice. Please consult a licensed tax advisor first. I love you all. I will see you in the next dividend investing video.